Hi, I'm Todd Phillips, tax attorney. Welcome to Smarter About Taxes. Today, we're going to talk about real estate professional status and why it matters. This is a basic intro video. If there's advanced topics you want to know more about, that's something that's between me and you as a client. I need to make a quick disclosure. I am an attorney. I'm not your attorney. An attorney-client relationship can only exist if we contract for it. Therefore, this information can't be used to avoid penalties or for tax planning or to recommend tax planning related matters to others. Take a moment, hit pause, read the rest of the disclosure. I appreciate that. Thank you. Why does it matter? Real estate professional. It matters because of passive loss rules that were enacted in 1986 by then President Ronald Reagan and the Congress. The tax code generally at this point restricted losses, what they would call paper losses. Some people call tax shelters. They restricted those losses from rental properties from offsetting other income like W-2 or investment income. People were investing in real estate in order to generate, purely to generate paper losses in the eyes of Congress and our then president. So they accepted means that they allowed you to get out of those rules if you were a real estate professional. Over the years since 1986, the IRS has tried to beat down the meaning of real estate professional and reduce it to the minimal number of people. We're here to help you with that today. So real estate professional status allows you to avoid the application of those passive loss rules. This gets hairy and complicated. I'm going to try to make it make sense. Key point here is only one spouse has to meet the test. So if you've got one spouse that's a high wage earner and another spouse that's a real estate professional, those two things can offset each other as long as that one spouse qualifies. Okay, how to pass the test. We're going to talk about, there's 4 parts to it. There's really a 3-factor test. There's really 4 steps. So we're going to go through them one at a time. But it's important to start out with this. Rental income is always per se passive income. I see videos on TikTok and YouTube and all the other social sites that are saying you can actively participate in real estate. You cannot. Real estate is a passive activity. They use the active rules from a trader business in order to apply that, and those are the rules we have to follow, but that doesn't mean real estate becomes active. There's a caveat to that. If you're doing short-term rentals, that means average stay of 7 days or less. You can be considered in the active trader business. That's not the point of this video. We'll have another one for that. If you have multiple properties here, this is super important. You probably should elect to treat all rental activities as one single activity. I've seen people or heard stories of people that have failed to do this, and it will trip up those rules. So make sure if you haven't already, and your person preparing your taxes doesn't know this, there's an election needed to make it to treat all your rental activities as one single activity. All right, so here we are with the 3 tests. Test 1, 50%, test 2, 750 hours, test 3, materially participating, and then we're going to talk about record keeping. So here's test 1, 50% test. This means at least 50% of the time you spend on trades or businesses. Okay, that's a defined term. We can talk about that offline if you need to. But 50% of that time, more than that, must be spent in real estate. Having a W-2 job makes this hurdle way more difficult. I think some people would tell you impossible. So if you have W-2 income, you better be prepared to explain under audit how you're spending more time on real estate than you are in your full-time W-2 job. So if it's a part-time W-2 job, or I'm sure you can come up with exceptions, but make sure you're aware that it gets really hard when you have a W-2 job. Okay, what does it mean, real property trader business? This is also a defined term in the tax code, in the regulations, and by the tax court. So this is one of those things that there's probably, a dozen or so factors that out there that you have to really look at. How's the court treated it in your district? How's the IRS going to treat it? We have to think through those things, but basically the code says this. Personal service, basically we're going to get to that in a different slide. This is an important point here. Personal services as an employee shall not be treated as performed in real estate trader business unless you own 5% or more. Okay, so don't forget that. All right, moving on to the 750-hour test. So now we're going to talk about real property trades or business. This definition isn't as straightforward as it sounds. There's nuances to it that you wouldn't think just by reading this paragraph I have here. Or if you go out on the internet and research it, you're probably going to get half or less of the story. But the code says directly, this is Internal Revenue Code. You see the citation at the bottom. That's what us attorneys use to cite the actual tax code. The little squiggly line means section. Internal Revenue Code, section 469C7C. For the purposes of this paragraph, the term real property, trade, or business means any property, real property development, redevelopment, construction, reconstruction, acquisition. I'm going on. You understand, it feels very broad, but again, like I alluded to earlier, the IRS is trying to shrink that down and make it less applicable. So beyond the scope of this video to talk about how everything fits in there, but I can tell you, let's say you're in the HVAC business, and if you're doing HVAC on new properties, it's different than if you're doing HVAC repair work. So repair work might get you out of being a real estate professional, but building new properties might get you into real estate professional. Take a close look at that with your advisor. So that's 750 hours and 50%. Okay, the last test. This is where I think there's some confusion in the market. These are the Treasury regulations. So what happens in law is Congress passes a law. It's still long and complicated, but it doesn't always address every single thing. So then the United States Treasury gets to write regulations. And there's 6 or 7 regulation books for every single tax book. So you can imagine it's got a lot more detail. So they took in the regulations and borrowed from this material participation rule. So if you're in the business of creating computer software and that's your business, that's a trader business, you have to figure out whether you materially participate in that. So here's these rules don't exactly apply to the real estate professional. So I'm going to highlight the ones that I think are the most important. Number one, taxpayer works more than 500 hours in the activity. Okay, we've already kind of done that in test 2, right? We said 750 hours. But this is where people get tripped up in the aggregation. So make sure you're making that election to aggregate all your properties together as one so that you can meet the 500-hour test. You only have to meet one of these tests. So if you did that, you're probably pretty good. Okay, here's the other one. Taxpayer works more than 100 hours in the activity and no one else works more than the taxpayer. This is where I see a lot of other people get tripped up. If you own a property and you're really a passive investor and you're going to claim, I'm a real estate professional because I review the financial statements of these people, but someone else is really doing all the work, this is where you're going to kind of get in trouble, is other people doing the work. So, you know, if you're just supervising and reviewing and you're not doing much, that's where you're going to get into trouble with these rules. You have to actually be actively and materially participating in the properties in one way or another. That's why this last piece, record keeping, is super important. So I went through before I made this video and I looked at some of the tax cases where people had lost. They had been challenged as a real estate professional and they lost. And I can tell you this, almost every one of them came down to record keeping. So it's important to track what time you're spending on real estate professional activities so that if you get audited, you have that. You have the 750 hours, here's where I did that. But more importantly, I saw people lose on the 50%. So keep records of the time spent and the nature of what you're doing. And then keep track of time spent on other non-real estate trades or businesses. So if you're an attorney like me and you're doing legal work, that's not necessarily real estate work. So you got to track that, because that's where people get caught up, is the court says, well, you didn't, you know, there's no way you could have spent all this time because you're also an attorney. Maybe they didn't. Maybe they did very minimal work, but the court said, we don't know that. You didn't present that evidence, so therefore we are going to assume you spend more time in your trades or business. So most taxpayers, again, lose in court over record keeping versus the type of activity. So work with your professional, make sure you've got the right type of activity, you've got the record keeping, and you've got record keeping for things that are not real estate activities. So you have that full defensible position on here. Okay, next steps. This is the end of this video here real quick, but meet with your advisor, map out your particular facts and circumstances, and chart a course to meet both the material participation rules and the real estate activity rules. Thank you. This is Smarter About Taxes. I'm Todd Phillips, tax attorney. Make sure to like and subscribe all these videos so we can continue to create more content. Thank you.